In this video, we're going to talk about Fuelcell, trading under the ticker symbol FCEL. We're going to cover the price action over the past few days, the company itself, and the recommendations regarding buying, holding, or selling the shares. If you would like to see more stock analysis videos, please like, comment, and subscribe to my channel. But before today's video begins, I'd just like to clarify a few things about the timing when my videos are recorded, uploaded, and how much they react to the latest market updates. Those are prepared, recorded on the day before, and scheduled for the next day. If there are significant and volatile movements during the trading day, they will not be reflected in the video itself. With that being said, to the extent possible, my analysis will be based on the medium term, or even the long term, and not necessarily on the intraday movements. The main reason why it shouldn't matter that much is because most people investing in stocks, or even just trading in and out of their positions, usually keep their positions open for at least a few weeks. With that being said, if there are significant movements in the stock price that happens afterwards, either they will not affect the overall picture, so in that case we will cover them the next time we're supposed to cover them, or if they are significant enough that they change the outlooks, then yes, I will do a follow-up video in the shortest delay possible with a reevaluation of what I think should happen next. Fuelcell is a company operating in the energy generation and management sector and has developed several alternative energy generation methods over the years. Its appeal is the fact that the generators use natural gas to power up the generators, which is more environmentally friendly compared to the combustion generators. Many retail investors initially discovered Fuelcell because they were looking for fuel cell startups that are looking to develop hydrogen-based solutions. Of course, Fuelcell, the company, is mainly using natural gas, but nevertheless, it fits the profile of many retail investors who decided to put their money into the company's stock. Essentially, Fuelcell is surfing on the popularity of hydrogen, a bit like some EV companies are surfing on the high stock price of Tesla. Fuelcell has also been operating for decades and is a well-established company with stable and predictable cash flows. In a way, it is an established company with renewed demand and curiosity from the rest of the market participants. The market cap of Fuelcell is currently at $3.6 billion, and the enterprise value is at $1.8 billion. The market cap is the price tag the financial market is willing to evaluate Fuelcell stock at, with consideration to its future potentials, as well as the short-term fundamentals. The enterprise value of the company is the net result of the company's assets once the debts are paid back. Usually, the market cap is higher than the enterprise value, but sometimes there may be exceptions because the company may be highly leveraged or the company may be under a lot of pressures from the market, such as large short positions. It is not the case for Fuelcell. The quick ratio of Fuelcell is 11.86, the current ratio is 13.36, and the debt over equity is 0.12. The average trading volume of Fuelcell has been 39.45 million shares, and the daily volumes have been 24.7 million shares, 33.5 million shares, and 23.8 million shares recently. The 1-year beta of Fuelcell is 2.38, so it's more than double the volatility of the market. Its 52-week high is $29.44, and its 52-week low is $5.34. Now, let's also talk about the options market for Fuelcell. In terms of volume and open interest, the options market seems to favor the calls option side. Generally speaking, the put options mean that the market expects a pullback, and the calls options mean that the market expects the prices to move up. The key strike prices where there seems to be the most interest at are $9.50, $10, and $11. Something that sets Fuelcell apart from other stocks is that it has a lot of following from the retail traders community, and that unlike many other companies that rose significantly back in 2020, Fuelcell is a company that has been around for quite a long time. This doesn't necessarily mean that a company isn't good, or that the collective wisdom is wrong, but it does require us to examine those phenomena apart. Fuelcell is in the energy business, mainly in methane and natural gas. Its appeal is that it attracts investors who believe that environmentally friendly energy sources are going to take more importance in the decades that follow. The technology to capture methane from landfills, the idea that natural gas equals clean energy, and the psychological links between fuel cell and some other names of the industry like plug are some of the most compelling examples why investors are willing to put money into fuel cell. The thing to consider is that fuel cell isn't just the name of this company, but also the name of a new energy source that is also linked to hydrogen. The appeal of hydrogen is that it is a truly clean energy, but current technologies are not mature enough to fully benefit from its potentials yet. Meanwhile, my understanding is that Fuelcell, the company, gained a lot of popularities in 2020, mostly because a lot of investors believe that the company is also involved in producing hydrogen. And then it evolved into this narrative of company being a great investment because it wins prices, it has methane capture technologies, and it is part of a great movement that will turn the energy sector upside down, inside out, in the decades that follow. Honestly, is it possible? I believe so, but there are significant investments that are required for Fuelcell, the company, to be able to actually fulfill the wish of investors regarding Fuelcell, the concept. If we look at the company as it is right now, I think that Fuelcell is a traditional natural gas operator that is currently incurring losses. If the approach taken by your portfolio is to concentrate on the energy sector, then I believe that Fuelcell should be at least part of your considerations. Otherwise, it's suffice to say that the company has a higher risk profile than many other choices in the market. If your approach is the one that I mentioned, then I would recommend to have an exposure of 0.5% in Fuelcell and save at least 50% of your allocation for later. The profit target should be between 30 to 50% of your cost basis, depending on your risk tolerance. And if afterwards you're willing to still invest in Fuelcell for the long term, then maybe just put in your profit in the company and let it roll. Your investment should also take into consideration the market conditions and the surrounding sentiment to determine what kind of asset should be picked, for how much and for how long. First of all, the financial market doesn't reflect the real economy. If the stock market is doing great, it doesn't necessarily mean that companies are hiring people, that salaries and living standards are rising. Sometimes it's the exact opposite that happens, because the stock market is a pool of money where things come in and come out, going to different sectors to be placed. The capital may be used to be invested in a company to improve its efficiency and productivity, but it can also be used to buy up shares and assets in order to make a profit. This phenomenon is called financialization, and it means that the more money is being used for non-productive purposes like merger and acquisitions, fees to financial sectors, buying back equity, and so on, the less there is for the real economy. Another way to put it is that ever since 2008, the Dow Jones has increased significantly. But people don't necessarily see this growth in tangible ways. This is why we gotta be careful with the assumptions that rising stock price means better outlook for the company. Sometimes it doesn't mean anything other than the fact that the asset is getting more expensive to be bought and that their yields is going down as a result. Additionally, some new phenomena are now palpable, such as the creation of new bubbles, the participation and influence of retail traders in specific situations, and the anticipation of a massive recession or at least pullback. Bubbles have always been created on and off over the past few centuries, but nowadays it's quite interesting to see the speed at which an organic bubble can be created back in 2020. Because almost immediately after the major collapse of the financial market back in early 2020, the market decided to pour a massive amount of capital in the EV sector and anything that's related to it. Stock prices went up the sky, and for a moment, it really felt like any EV stock can be a golden goose. Another way to say this is that any SPAC with an EV company in it will become the next Tesla, right? Even if it didn't last that long, this episode definitely allowed the market participants to park a lot of their money in a sector, leaving it with either a lot of profits or at least avoiding incurring large losses because they left their money in the blue chips or the sectors heavily affected. The involvement of retail traders in companies has also been much more pronounced in recent months, especially in the scenarios of a short squeeze. Companies may have short sellers who believe that the stock will decrease in value. The short squeeze consists of buying the stock price up to force the short sellers to recover their positions, which will then also trigger an even bigger increase of stock price as a result. Of course, I'm not saying that this is always rational. I'm not even saying that those companies always have a convincing narrative. So, for example, if you play video games, ask yourself if you personally bought all your games at GameStop, knowing that you can buy the same games just online in the comfort of your home. But nevertheless, retail traders do have a much more significant influence in the stock price nowadays, for the better or worse. Personally, I think that as long as the volatility is high or gets higher, it'll create more opportunities. The final phenomenon is the anticipation of a recession. Many people have been expecting something of that sort to happen ever since 2008. There were quite a few companies that were supposed to go bankrupt because their debt structure is no longer sustainable or that their business model is bad. But overall, the system was able to hold its ground, especially in the North American market. This is partially because capital around the world often choose to come to the American capital market when things get heated back home. This is especially the case when geopolitical tensions increase around the world. In order to make sure that capital can provide a steady return without being affected too much by the central bank policies and inflations, I think that this phenomenon will increase its pace as time passes by, at least for the next couple of years. This is why we will likely see the blue chips continuing their ascension, even if for the growth stocks, things may be a lot more nuanced. The bottom line in all this is that the environment is getting more uncertain and volatile in a context where asset yields will probably remain quite low, because the real economy cannot be improved with just money. As far as we're concerned, this means that the patience would be a great virtue for all of us, and that there will be plenty of opportunities to eye for better prices. With that being said, always make sure to keep your positions diversified and keep the risk level under check. Speculative positions should play a small part in your overall portfolio. I would say it's better to keep them below 10 to 20% of your total holdings. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.